So today we'll be talking about the demand for insurance. Throughout the class, we went through how consumers demand healthcare, and that's just normal healthcare without insurance. And we talked about how they're inelastic to the cost of healthcare. So no matter what the price is, they're still going to get it if they're in dire straits. Then we talked about the supply side and broke it up into two buckets. How do physicians act economically versus how do hospitals act economically? And we talked about how they want to have more services rendered if they can do it at a higher price. So they will do everything economically in order to provide more services, especially if they're getting more income. Now we talk about insurance and why there's even a demand for insurance from the consumer. The biggest reason why there's a demand is because of what we talked about happening on the consumer side. If a consumer is buying healthcare services and they know they're inelastic, one way to get around that inelasticity is to make the unknown known. And what the unknown is the unknown cost that they're going to have to bear. So we talked about the failures of the market and how there's asymmetric information and there's a lack of transparency, so consumers don't know what they're going to pay. What insurance helps to do is make the payments more predictable. And that brings now the certainty around healthcare costs rather than the uncertainty. So when you buy health insurance, you pay a monthly fee and there's certainty around what you're going to pay. And even if you're paying a monthly fee and you end up paying copays and deductibles, there's certainty. I know we talked about the bitter pill, where at times, even when you have insurance coverage, things aren't covered. But for the most part, what insurance is trying to do is bring certainty to a market and to an economy where there's uncertainty. So the demand for insurance is driven by the fear of the unknown. And so to try to make that unknown cost that the consumer doesn't know about more predictable, people buy insurance because they pay the same amount every month to take care of their healthcare costs. And if their healthcare costs are high, they don't pay more than their insured allowed amount, and they know what that is. People have an out-of-pocket maximum amount, they have a copay amount, they have a deductible amount, but it's a known amount. And if they pay less, they're willing to pay less out for the predictability. So there's a cost to predictability, and that's really what you should take away from this first part of the conversation, is that we are now putting a price tag on knowing your healthcare costs up front. And what insurance attempts to do is make you know your healthcare costs up front. And there's a premium to it. And that's why health insurance companies can actually charge a profit for making sure that we can possibly make your costs known. So all purchasing insurance really means at a very basic level is forfeiting income in the good times to get money in the bad times. And so you're saying, I'm willing to pay money now to make my healthcare costs much more predictable in the future. In bad times, you lose the money. For example, if you buy insurance but you never get sick, then you're like, should I have bought it in the first place? However, you cannot discount the fact that you had peace of mind that you did have insurance. So everything around insurance is around risk and measuring someone's aversion to risk. And the more you're adverse to risk, the more you will demand insurance. So all that means is if you believe that you are more inelastic to healthcare costs, meaning that regardless of the price, you know you're going to buy it, and you want to avoid that shock of not knowing how much the price is going to be, and you know you have a high probability of getting sick, then it's highly likely that you will buy insurance. And that's why you see older populations that know that they're going to have healthcare costs buying health insurance more. I mean, I remember we talked about the slides on the first week of showing who bought coverage from the exchange, and older populations bought health insurance coverage way more than younger populations. And the exact economic reason why is because those older populations were more risk adverse, where the younger populations were saying, I'm not going to give up money when I'm healthy to worry about when I'm sick, because I have a very low probability of becoming sick, so I'll keep the money for myself. and we'll get into utility, but at that person at that point in time felt the money in their hand was worth more to them than the money in their insurance policy to hedge against a potential loss. You're paying money to protect from something that might happen. So when there's a higher probability for it to happen, you pay more for it. And when there's a lower probability to happen, you might pay nothing. So we can actually model this risk aversion, and we can measure how much people will buy. And health insurance companies measure how much people are going to buy based on their risk aversion. And it also has a direct correlation to income. How someone utilizes their income and what they get from their income will dictate how much they want to protect themselves from a loss. So utility to income, this is very key. The utility of their income will have a direct correlation to how much insurance that they buy. Utility increases with income. So you will be more likely to buy insurance the higher your income goes because you use the money more and you'll protect yourself from a greater loss. And we will do the same measurement on marginal utility for insurance that we did for anything else in the previous chapters. And so marginal utility of income declines over time. Sooner or later, you will make so much more money that you start to say, one more dollar won't bring me more value, so I'll stop. I'll stop buying insurance. And that's what that's talking about. The marginal utility for income always declines because it's saying what decision will change when I get one more dollar. Sooner or later, you'll get to a break-even point where one more dollar won't change your behavior. And that's when marginal utility starts to decline in your income. So what does that mean? If you put it on the graph, you'll see utility increases with income. As utility goes up, income goes up. And then marginal utility decreases, so you start to see the slope of the curve flatten out. So there's a point in time where you're making so much money that you can't get any more utility out of the money. And that's a sort of a break-even point where the example that I used was Bill Gates. You know, if I give him one more dollar, will that change his behavior? No, because he's a multi-billionaire, which is very, very different than someone who's poor. And if I give someone who makes $15,000 a year one more dollar, that $1 means more to them than $1 than it does to Bill Gates. And measuring what it means to a person based on their income is utility. So why does utility matter for insurance? Because it's all about managing the probability of how you're going to get sick. So here you see an individual doesn't know whether she will become sick, but she knows the probability of sickness is between 0 and 1. So you can say in 2018, I know I might get sick. And based on my age and my demographics and my history and my hereditary and my background, I have a probability of 0 to 1 to 100% that I might get sick. Now, if I have high income, sickness means that I will make less money. And why we say that is in healthcare allows people to be more productive, a very important concept. Even if you go back in the day to when Germany started their first scheme for health insurance coverage and came out with their first universal healthcare model, the Bismarck model, back in the day, like in 1800s, the theory was if I give healthcare to the union workers, the low-income union workers, they'll actually come to work more often and they'll work longer days, they'll work longer hours. By not giving them insurance, they got sick. There was absenteeism, and I was wasting money because people were not coming into work and working in the manufacturing firms. So even back then, people looked at healthcare in terms of productivity, and that hasn't changed to today. You can see if she gets sick, medical bills will arise and you'll miss work. So the medical bills reduce your income because now you're using your disposable income for something else, medical bills, and you lower your hours. So you're losing income from that perspective by not working as many hours. So that absenteeism is a lack of productivity, which impacts your income. So being sick actually hurts your income. The more utility you get out of your income, the more of a loss you will have by being sick. So insurance will protect you from losing your income. You're hedging against that bet. You're trying to be risk adverse. And that's really the takeaway on this first part. If I take a step back and try to recap everything, essentially, the demand for healthcare is inelastic. I can't choose when to get sick, so I'm inelastic to the price I have to pay for healthcare. That makes it worrisome because I don't know how much I'm going to pay. I don't know when I'm going to get sick. I don't know the probability of me getting sick. So I don't know if I'm going to spend money. That makes me nervous. So to try to mitigate that and make healthcare more predictable, I now demand insurance. That's where the demand for insurance comes from, because now I'm going to pay a set dollar amount and it'll make my healthcare costs more predictable. I know I'll have a ceiling and a floor. I know I can't spend more than X. That's the hope, right? Except for the examples that we had in Bitter Pill. So now if my dollar means more to me than it does to Bill Gates, by losing my dollar, it's a bigger deal to me. So I'm going to buy insurance to protect me from the loss. So I'm willing to give up my dollar to protect me from losing dollars potentially down the line. And that's the opportunity cost that happens to someone based on their utility of income. So there's this concept of expected value versus unexpected value. So if you take the basic principle of probability, right? The example that they show here is, suppose we offer a starving grad student a choice between two possible options, a lottery and a certain payout. The first option is a lottery that awards $500 with a 50% probability and 0 with a 50% probability. So I can either win $500 or have a 50% chance to win $500 or have a 50% chance to win $0, right? Obviously, you know that the average of that is $250 because I have a 50% chance to get $500 and I also have a 50% chance to get no money. So on average, I'm going to gain $250. Or I have a known probability of 100% to get $250. Which one would I choose? Now, the key here is that because the student is starving, they're most likely going to choose the lower amount that has a higher probability. I'm more likely to say, give me $250 at a probability of 1 because I know I'm going to get $250. And that means the utility that they have for income is much higher because $250 means more to them, so much more to them that they'll take a lower amount that's a guaranteed probability than take a chance at a higher probability. Now, if I ask the person who just finished a steak dinner at Peter Luger and was full, hey, you have a chance to get $250 and they're rich, or and it's guaranteed money, I have it right here, or you have a 50% chance to get $500. Which would you choose? Potentially the person who's full and rich would say, what do I got to lose? If I don't get the $250, it's not that big of a deal. So let me take a chance and get $500. And so depending on your utility, it changes the decisions you make. And so the person who chose the $250 at a probability of 1 is essentially the type of person that bought insurance because they're making less income up front to guarantee money down the line. That's the scenario they're trying to make a parallel to. So it's like, I know I make $500 a month, but I'd rather pay insurance of $250 so I can guarantee I keep $250 of the income that I make. Where if I was rich and I had nothing to worry about, I would say, you know what? I'm going to take a chance. Give me the $500 up front. So a healthy person might say, hey, I'm not going to pay insurance because I'm probably not going to get sick. So let me take the $500 income and not buy insurance. And that's the decisions that people are making based on their utility of income. So the reason why people buy insurance is to avoid risk. And how you measure someone's risk is to see their utility of income. So what do you find? You're going to read in the book that people usually prefer a certain payout. instead of uncertain scenarios. So think about this. We actually push the American people to buy insurance because we know the demand for healthcare is inelastic. And if people prefer a certain payout, then they're not going to just live without insurance. They'll feel more comfortable buying insurance so they have a certain payout and they know what their payout's going to be. So the sheer fact of uncertainty in the market leads to creating a market for insurance. So if you wanted to get rid of insurance altogether, you would have to figure out how to get the price of healthcare more predictable. And that's why transparency is so important. That's why symmetrical information is so important. If you wanted to get rid of all the insurance companies and get to a single payer system, it's predicated on the notion that you must have transparency so that someone knows what they're going to pay. The minute someone knows what they're going to pay, they start to become less risk adverse, and then they start to have a decline in demand for insurance to make sure that they have a predictable outcome. And this is important for your papers if you're trying to figure out how to increase access to care or how to make sure that people have coverage. If a student says he prefers an uncertain option, what does that imply about their utility function? We talked about this. It probably means they're not starving, right? They'll take a chance. They have a 50% chance at $500. If they're not starving and they're a rich student, they'll probably say, yeah, I'll take a chance. I'd rather get the $500 than take a known $250 that's less. And it's all about utility. So expected utility is measured in a formula below. You can see what it looks like. It's very confusing. You don't need to know it for the test. The key here is just knowing that expected utility comes from the sum of the utility for each of the possible outcomes weighted by each outcome's probability. So I have a probability to get sick. And then there's different sicknesses I can get. All those sicknesses have different prices, which means there's different outcomes. To measure my expected utility, I would have to get all of those scenarios, put it into this formula, and it would tell me what my expected utility is. And this is kind of what we do for insurance companies to derive a price of how to price an insurance policy for someone. We base it on what we think the probability of their health outcomes are going to be. That we back into that based on data, historical data. So I know the probability of a 40-year-old, how much health care they're going to have. I know the probability of a 25-year-old, how much health care needs that they're going to have. And I put in all the possible outcomes, and I weight it by the probability, and I can come up with expected utility for that person. What the Affordable Care Act did, however, though, was stop at least what we call underwriting, which is what this is, basically trying to find expected utility for someone, in the individual market and in the small group market, and said, listen, you guys can't charge someone who's 80 $1,000 a month for insurance and then charge someone who's 19 $10 a month for insurance based on their expected utility. You cannot do that. That's unfair because you're pricing out the older people. So what the ACA did was say you can only have a 3-to-1 ratio of how much you can charge. So if I charge the 80-year-old $1,000, I can only charge the 19-year-old $300 because I have to have a 3-to-1 ratio. I can't charge the person way more than 3-to-1 because they're older. So what that ended up doing was raising the costs on the folks who were healthier and potentially younger. And so what that did, when you raise the cost of insurance on a population that is not risk adverse, that has a high utility for money, it means that they stay uninsured because they're like, the money is very important to me. And you just raised the insurance cost and my loss is going to be less than what I'm paying for insurance. The minute that happens, opportunity cost kicks in and they say, I'd rather stay uninsured. And that's sort of what happened when we launched the ACA. We didn't price the healthier folks as cheap as we could have. And so when that price went up, they were less likely to buy insurance due to their expected utility. So going on with the same example, the student's preference for option B over option A implies that his expected utility from B is greater than expected utility from A. This is exactly the definition of opportunity cost. That $250 means more to them than potentially getting zero. They have a 50% chance of getting zero. And that chance led them to take a lower amount. And that's exactly why people buy insurance. It's like, I have a 1% chance to get cancer, but that cancer treatment is going to cost so much money. I'm going to lose so much money that I'd rather give up my money now to protect me from the 1% chance I might get cancer. And that gives me an expected value. So consumers like expected values. And if you give them expected values, they will not need to have a demand for insurance to protect them from a loss because they'll know what the loss is, right? Students are acting risk-adverse manner over the choices available. Most people act risk-adverse unless they are willing to give up money. So you think of it, expected utility without insurance. So how we look at it, you take the same example and put it in the insurance realm. Now we have income H, which is I'm healthy. What's my income when I'm healthy? That's I'm getting 100% of my salary versus income S. What's my income if I'm sick? I'm going to get less than 100% of my salary. And I can use this formula, which you don't need to know on the test. You just need to know the concept. But I can use this formula to figure out expected utility to know how much of my income am I willing to give up to protect me from getting income S. You have uncertainty around which outcome will happen, so you buy insurance to protect you from that uncertainty. And this is how it looks graphically, and it might look confusing, but I'll help you out. Income H, top right-hand corner, is me getting 100% of my annual income. Say I make $50,000 a year. If I am income H, that means I'm healthy. I work all of my 40 hours a week. I get 100% of my $50,000. And then income S is my income if I'm sick. So you can see it's much less than 50,000. Let's call it 25,000. So I make half of my income because I was so sick that I didn't work enough hours. I was out and I ended up going on disability and I lost my income. And I actually lost my income so much so that it was 50% of my income H. The points in the middle are based on the probability of me getting sick. So if I have a 25% chance of getting sick, I might get only lose 25% of my $50,000 annual salary. That's the point A. Versus the expected utility of 0.75 means there's a 75% chance I get sick. And so I might only make 25% of my expected income as opposed to making 75% of my expected income. And you can see those marks on the utility curve. So a case where the person is sick with certainty, they know they're going to get sick. It's P equals 1 because you have a 100% probability of getting sick. So they call it 1. Where you have a case where the person has no chance of becoming sick, and that's P equals 0. There's a 0% chance of getting sick, so they will get 100% of their income H, their full income being healthy. Versus P1, I have a 100% chance of getting sick. I know I'm going to get sick. I am at P equals 1, so I'm getting 100% of income S, the shortfall. And that's how we graphically show it along the utility curve. And you would draw a slope, and there's different slopes for different people, but you would draw a line and you would see that the when you have less than 100% probability of getting sick, you're below the utility curve, but you're protecting yourself against the potential loss. And that's why it's below the line, because you're protecting yourself from something that might not happen. And that's what happens when your P, your probability, lies between 0 and 1. It's not an absolute 100% chance or no chance. If it's in the middle, it falls below the utility line. So, risk-averse individuals. This is exactly why insurance exists. It happens in the car insurance market. It happens in a life insurance market. People prefer a certain outcome to uncertain ones with the same expected income. And they also prefer the utility that's from expected income to the expected utility from uncertain income. And that sounds confusing, but all that means is I'd rather take less money because it means more to me to know that I won't have to pay money out later at some probability. The only reason why I'm going to give money upfront to protect me from something that might happen is because I think there's a strong likelihood that it will happen. So the bigger the probability that I'll get sick, the more likelihood I'll buy insurance. That's the economic rationale for insurance. So the basic of an insurance contract, and this is how we write it, so economically, is the customer pays an upfront fee. The mechanics of insurance must be that they pay upfront. We need the money upfront, not after the loss. There's actually a term when people buy insurance after loss, and that's sort of like a moral hazard, and we'll get into that, I think, in later chapters. But the basic mechanics of insurance is they must lay the money out upfront. And the reason why we ask folks to do that is because we want people to buy insurance when they don't need it. That's the whole construct of the contract. And that payment is considered R, and they call it an insurance premium. And once you get ill, the customer receives Q, and that's the payout. So I'm paying a little money up front, and my hope is that my Q is greater than my R. If my Q is greater than my R, I made out because I paid the insurance company a sum of money, but my insurance claim was more than what I've been paying monthly, so I made out. The insurance had a bad bet. If your Q is less, you still have to quantify the peace of mind you felt by having an insurance policy, but you didn't get the full benefit of your insurance plan. You had to pay out money and you didn't get as much money back in your Q. Q is less than R, but you did get the peace of mind that if I did get sick, I would have protection. And that's what people buy insurance for, not to use it, but for the peace of mind that in case they have to use it. It's really mitigating a potential loss. And if you're healthy, the customer receives nothing. And nothing I put in air quotes because, again, they do receive peace of mind, and they do receive an ability to mitigate against inelasticity. The only way to mitigate against inelasticness in the demand for healthcare is to buy insurance because it makes it a more predictable payout. Either way, the customer always loses the upfront fee, and then you see the customer's final income. So when you're sick, income H plus Q minus R. Remember, income H is when you're healthy. So you're taking how much money I would have had if I was healthy. Then I get my payout that I got from the insurance plan because the insurance company is paying the hospital, paying the doctors on your behalf. You're paying some copays, but for the most part, the hospital is paying the biggest brunt. And then you have to subtract R because you've been paying upfront free. And you would hope that you made out. Where when you're healthy, and this is interesting, again, it goes back to opportunity cost, and this gets confusing. You start with income S because that's what the income would have been if you're sick. And you got zero payout because you didn't get sick. And you still have to minus R because you were paying money to protect yourself from income S. And so this is where people get a little bit confused, but because we focus on opportunity cost and the value, I have to say if I bought insurance but I'm healthy, I have to start with what I would have had, income S, the income if I was sick. And you would do the balance, and this is the formula you can use at the end of every year to figure out if you made the right decision of having insurance. So if you let income H and income S be income with insurance, you'll see here income H equals your income when you're healthy plus Q minus R. It's plus your payout minus what you've paid up front, where income S equals your income if you're sick, plus the zero payout that you're not getting because you were healthy. Still, you have to subtract the R because you pay your monthly fee whether you get it or not. And the risk-averse person always wants to avoid uncertainty. So for them, what they're trying to do is buy an insurance policy that makes their income when they're healthy equal the income when they're sick. And so that's how you know how much you're willing to give up of your income on an insurance policy, is to make sure that your healthy income would equal your sick income. Because when you have an insurance policy, it protects you from the loss. So my income S can turn back into my income H if I buy an insurance policy that gives me back money if I get sick. And so that's saying, say I'm out of work and I'm not making money, my Q that I would get, my payout, would be enough money that it would look like I was working the whole time. So the perfect insurance contract is an insurance contract that I would pay for that actually pays me out the same amount of money that I would have made if I stayed healthy. And that's why I say buying insurance mitigates the inelasticity of a consumer demanding healthcare. So that's the key principle here, is that I'm trying to buy insurance to make my income when I'm healthy equal the same amount of income I make when I'm sick, based on my utility. If I'm Bill Gates, it's very hard to buy an insurance policy that makes my income H equal my income S because of how much money I make. But if I make $15,000 a year, it's different because one extra dollar means so much more to me, so I'm willing to buy insurance to protect it. So when you have full insurance, it means that there's no income uncertainty. It's very rare that you can find full insurance policies. Some unions have very rich plans. Full insurance just means everything's paid for. But today, there's very rare. You have deductibles, you have copays, you have all these types of things. And plus the insurance company's trying to make profit. So full insurance is very rare, but for purposes of the economic principle, full insurance basically means there's no income uncertainty. You've eliminated any possibility, regardless of if you get sick or if you not get sick, regardless of the probability of getting sick, of you losing any income. I bought an insurance policy that protects me against all of my potential losses. Regardless of healthy or sick, the final income is the same. That's full insurance, a very important important point to know. Risk-averse individuals prefer full insurance to partial insurance, especially if it's the same price. But again, you rarely see full insurance in the market. I think only like unions that are required to give like these very rich benefits where they protect everyone from the loss. You'll see that it's almost close to full insurance, but it's very rarely seen today. And then we call it actuarially fair insurance. So there's full insurance versus air quotes, actuarially fair insurance means that insurance is a fair bet, meaning the premiums equal the expected payout. So that is, remember R is what you pay out? I'm going to say, you know what, if you pay me $100 a month for insurance, I'm going to pay you out $12,000. Actuarially fair insurance also rarely exists because then how does the insurance company make money? If I'm collecting $100 from every member, but I'm paying out $1,200 to them, at the end of the year, I have no money. I've paid out everything that I've gotten. So there's very rarely see actually fair insurances. You see insurance makes zero profit from actually fair insurance in exception. The only time I would actually make money is if you happen not to get sick. So then there would be no payout. But that's a very hard bet for an insurance company to take on. So they want to even make insurance plans less fair, so at least they can pull a profit from it. And if you wanted to talk about in your paper problems with insurance, you could talk about, I can eliminate the need for insurance by adding transparency and symmetric information so that people don't feel uncertainty. And if they don't feel uncertainty, then they wouldn't buy insurance to mitigate them from potential losses. And then the second part would be, you could mandate that all insurance companies sell actuarially fair insurance so that at least if you do buy insurance, there's no markups. You're not buying insurance that's not actuarially fair. If you use it, you get the full value of it. Now, as we've seen, simply by reducing uncertainty, insurance can make this risk-averse individual better off, right? Insurance reduces uncertainty. That's the key. And relative to the state of no insurance, with insurance, losses of income in the healthy state and gains income in the sick state. So if I buy insurance and I don't use it, it's a loss, right? And that's how I depict it as saying insurance when I'm healthy means I gave up money, but I didn't take my fair share out. I didn't get my payout. Versus if I'm in the sick state, I didn't make as much revenue as I wanted to, but I got a payout. So I offset the money that I didn't make because I was sick by the insurance payout that I got. And so in other words, as the slides say, the risk-averse individual is willing to sacrifice some good times in the healthy state to ease the bad times in the sick state. Again, very simplistically, I make $50,000. I potentially could be out of work so long that I would only make $25,000. So I'd use some of my $50,000 to buy an insurance policy that would pay out $25,000. So that at the end of the day, if I do get sick, I still make the income I would make if I was healthy. That's generally the gist. Now, an insurance company, and I work for one, we're not going to do full insurance because full insurance we would do at a loss. We would rarely do actuarially fair insurance, where whatever you pay in, you get out, because then there's no profit for me. The slide said 0 profit margin because you give me $100, but I got to give it back to you. So there's no way I make money. So what we do is we put profit into insurance so that we at least make money for holding the money and for a transaction. All right? We're trying to make money off of protecting you from a loss. So how do I do that? Take the same insurance contract from the point of view from the insurer. Premium is R, payout is Q. I know the probability of sickness based on background data. I use all the data and say 35-year-olds have X% chance to get sick. So I put a P of probability on the contract, and then I figure out my expected profits. And so the formula that insurance companies use, you'll see it there, is there so that I can make sure that even if I do a payout, I still make money at the end of the day. What you need to know, the concepts you need to know from these couple slides is that an insurance company is not incentivized to offer full coverage or actuarially fair coverage because they don't make money. And as a supplier of insurance, we're on the supplier side. So what do you think our economic, as an efficient producer, how do you think we want to act? Our economic incentives are. Our incentives are to supply insurance at a higher premium as possible. So we would all be developing insurance plans that have a profit margin from the supplier side. So in a perfect competitive insurance market, profits equal 0. There's never a perfect competitive market, but what the Affordable Care Act attempted to do was say, I'm going to flood the market with insurance companies. They're all going to have to come up with a price to get the most members, and so they'll fight to lower their price, which means they would cut into their profits. So you create an economic system where supply and demand is the same, and so it would force down the costs for health insurance, and so it would cut into the profit. So as close as you can get to a perfectly competitive insurance market is how you could get the profit margins for insurance companies to get out. But remember what we talked about the first class. People are leaving the insurance market. So as people leave the insurance market, the market becomes less competitive. So what do you think happens to profits? It goes the opposite from 0, it goes higher. With less competitors, the demand for insurance grows. When the demand for insurance grows, people want to protect themselves from a loss, able to offer more expensive insurance. So if you want to keep insurance companies but lower their profit margin, you have to create an environment where insurance companies want to flood the market, there's lots of competition, costs go down, and they will cut into their own profit margins. And if I can get the insurance company to offer insurance policies to people to protect themselves from a potential loss, and to get the profit margin down to 0, it's almost like they're offering actuarially fair insurance. So when insurance companies make 0 profit, it's actuarially fair. Now, how much profit do insurance companies make? 1%, 2%, 3%. So how unfair are these insurance contracts? 1%, 2%, 3% on average, right? There's some insurance contracts people make a lot of money on. There's some insurance contracts we lose money on. We have people that we sign up and they pay $400 a month, but they have a claim that's $200, $1,000 multiple times over, $5 million. So we don't make money on certain insurance contracts, but we try to make money on other ones. And we, at the end of the day, on average, do a 2 to 3 to 4% margin. An insurance contract that yields positive profits is unfair insurance. And they call it unfair because the person's not getting the payout that they put in. Whenever someone puts in more money than they get out, economically, it's considered an unfair insurance product. An insurer would never offer a contract with negative profits. That's the key. So economically, how would you incentivize insurers to offer contracts with negative profits, which would mean the cost of insurance would go down? What the government did was create something called the 3 R's: risk adjustment, risk corridors, and reinsurance. And what they said was, if you only get sick people, these are people who are going to buy insurance and use it, right? So that means you're going to pay out. All of your insurance contracts are paying out. They'll actually take money from the people who signed up healthy folks. They'll take the profit margin from them and give it to the profit margin to the people who signed up sicker folks. That's called risk adjustment. Basically, and your final case study is on risk adjustment. It's a bonus. It's extra credit. You don't have to do it, but it is a very, very interesting article. And it explains how to incentivize insurance companies to lower their price, they basically came up with a scheme called risk adjustment to say, if an insurance company makes a lot of money and only pursues healthy folks, we're going to take their profits and give it to the insurance company that signed up sicker folks, that way they had to make a lot of payouts, a lot of Qs, right? That's the first R, risk adjustment. The second R is risk corridors. Then they said, if you lose money up to 3% loss, so you run at 103% margin, you ran 3% higher than you actually brought in, the government would give you back money up to 3%. So it's protecting you from losses. So if I know that I can run at a loss, I'll sell insurance plans cheaper, and I would sell actuarially fair insurance. So this was another government intervention that they did. Risk corridors. And then they also said the other way, if you make too much profit, right, they're going to also limit the amount of money of profit you can make. So I could lose up to 3%, I could gain 3% margin, but anything more than that, the government would come in and take it away or offset it and help you, right, within those corridors. And then the last one was reinsurance, which was if I had a shock claim, and we call shock claims very, very expensive claims. Say I had a PQ-NICU birth, and the birth cost $2 billion. The federal government would pay 80% of that claim. They would say, $2 million, I'm going to pay 80% so it doesn't hurt you. So that I would have to pay out. Think about it. If I had that PQ-NICU birth, that's a $2 million claim, my Q would be $2 million to the person to make them whole. But the federal government said, no, don't worry, I'm going to pay 80% of your payout. So that means I get to keep more of my money, which means even though I'm selling fair insurance, even though I'm selling insurance at a loss of money, I'm not paying out the full Q because I'm getting this reinsurance from the federal government, paying 80% of the expensive cost. So that's how someone could actually operate at negative profits and still be profitable because of this thing we call the 3 R's. Risk adjustment, I take profits from the rich plans and give it to the poor plans. Risk corridors, I put a floor and ceiling around how much money you can make or lose. And then reinsurance, I start to pay a portion of your payouts for claims or sicknesses that are very, very, very expensive, like a PQ-NICU birth or like a trauma victim or like a burn victim. So the demand for insurance, what you need to know for the test and to help you with the book is the demand for insurance is driven by people who are risk adverse. The reason why they're risk adverse is because the demand for healthcare, which is different than the demand for insurance. The demand for healthcare is inelastic, which means regardless of the price, I'm going to have to buy it because I'm sick. In an inelastic environment, I want to protect myself from a loss because the price could be so expensive. So let me buy insurance to make my uncertainty more certain. Insurance makes things predictable. As you have diminishing margins of utility, meaning the dollar means less to you, you're more likely to protect yourself from a loss because you make a lot of money. As your money means a lot to you, you're more likely to keep the money for yourself. And that's why someone who's poor will take 100% probability to make $250, which means they'll say, I'm not going to buy insurance. I will take the money now, compared to a richer person who's like, I'll take a chance to make $500, which means I'll pay money up front to potentially protect me from a loss. So depending on where you fall on the utility curve will depend how much income means to you. And if income means a lot to you, you're less likely to buy insurance because you don't want to. You don't have a lot to lose, right? So you're not protecting yourself from a greater loss, and you also the dollar means so much more to you, so you're going to keep it. So when you do your opportunity cost, you're going to say the dollar is better in my hand than in the insurance company. Whereas someone who makes a lot of money is more like, whoa, I'm really rich. I don't want to lose this. I don't want to have this loss. I don't want to lose any money. So I will pay money in the good times to take care of me in the bad times. People who do that have a lot of money. They have diminishing marginal utility for income, right? So that's the key. And risk aversion can explain not only the demand for insurance, but it also can help to explain large family size, portfolio diversifications, farmers scattering their crops and land holdings. And all this means is when you're risk adverse, you try to diversify, right? Portfolio diversification means you don't put all your eggs in one basket. You have stocks, you have bonds, you have real estate investments, because you don't. If one investment goes bad, you can offset it with other investments. Same thing with farmers. They don't put their crops all in one field because God forbid something happens, then the entire crop is done and they get hurt. What they would rather do is mitigate it by putting it in different areas. So if one goes bad, they can offset it with the other. Risk aversion drives the purchase of insurance. So if you are looking to eliminate the construct of insurance because of what you read in the bitter pill, the key would be to how to make the demand for healthcare more palatable, more predictable. And the one way to do that is through symmetrical information. Eliminate the asymmetric relationship that they currently have, and pricing transparency. If I know how much things are going to cost, it's more predictable and I can plan for those costs. But because I don't know how much things cost, I have apprehension and there's uncertainty, so I'll buy insurance, which makes things more predictable.